Okay, everybody, thank you so much for joining us today for the session that we call Realities of Funding. We're going to be speaking with investors today. We're going to be speaking about investment. So this is going to be a session that you can't forget. We're really glad that you joined us. And I think at this point, I'll just pass it over to Luni, who's going to be moderating this session. Luni, please go ahead.
All right. Well, thank you, everybody. We're going to do this one more as a discussion than slides, although I do have a few slides to show. I can't speak without slides. And I have a very special guest for you today, which is Rebecca Mincy from the Acumen Resilient Ag Fund. So why don't we just start with an intro for Rebecca?
Sure. Hey, everyone. I'm Rebecca. I'm the investment director from the Acumen Resilient Agriculture Fund. We're a $58 million venture capital fund. We invest in climate smart agriculture in both East and West Africa. And in addition to equity, we provide a technical assistance facility, which is grant capital to our portfolio companies. We're a fairly new fund. We started in 2018, started deploying in 2020 in the middle of COVID. And since then, we have made 11 investments. We're closing on our 12th investment, fingers crossed, this week. And really nice to connect with you all. Happy to tell you everything I know. So thanks for inviting me, Luni.
And you're not brand new. This is not your 12th investment. Where were you before that?
So before the Acumen Resilient Agriculture Fund, I was actually on the Acumen side. So my fund, the Acumen Resilient Agriculture Fund, is a for-profit fund. Acumen has about 3 of those, soon to be 5 now. But before that, I was on the nonprofit investing side. So the Acumen that does very early stage, high risk investments that we think are going to be really transformative to the sector. I was on that side before I joined the for-profit side. So I've been at this since, for about 11 years now. Thanks.
Yeah. Oh, great. Me too. So everyone here, all the entrepreneurs know me as the guy who teaches them things, teaches them the hard stuff. I also am an investor. If you don't know that, I think I did my bio in week 1, but just to recap. So I've been building the Fledge Accelerator Network since 2012. That is a network of business accelerators, another word for technical assistance. We've run programs in 8 cities. My fund is invested in 105 companies in like 40 countries all around the world. I always forget that number. About 3 dozen in Africa. And then in the pandemic, my shift was to Africa Eats. And Africa Eats is an investment holding company. And what that means is that we invest in a specific set of companies. So it's not a fund. We're not investing in companies and trying to then unwind our positions in 10 years, like a lot of funds, see acquisitions or repayments. We have 2 dozen companies that we were invested in and expect to be invested in forever. It's a very strange model, a very uncommon model. All those companies came through a Fledge program somewhere, including this one. So I think we have 3 or 4 overlaps with this program. And I see Rekia is now in the room, so we can get her on the screen. And Rekia, you're going to tell us your background and how you got into investing.
Thank you, Luni. Hello, everyone. Good afternoon. Good morning. Still morning where I'm at. I'm Rekia Foudel. I am managing partner and founder of Barca Fund. I want to be Luni. That's it. That's my introduction. I say it all the time. I'm originally from Niger in West Africa, but I grew up in the States. I'm currently located in New York City, work in corporate finance for a while, and then had an opportunity to go and live in Niger, where I helped the government raise funding for themselves. But that also gave me the opportunity to observe the ecosystem of ventures started by young men and women like yourselves, who needed funding, but were not able to get access to it. One, Niger is Francophone, and so there's a big language barrier, not only language in terms of French, but also business language, right? That's a key part of how you get funding, is knowing the business language. So a lot of these ventures were not able to have access to funding because of the lack of business language, and also because most of the funders were focused in Anglophone Africa. One of the things we did when we first started was making sure that we build ourselves in the ecosystem, build our reputation or our name. So we didn't start fundraising first as a fund, but more trying to figure out how to build a pipeline. And so we're fortunate enough to have met Amanda and the team in Land Accelerator in 2021, and then Luni, and then realization that I want to be Luni, and ended up working alongside the Land Accelerator as the investor partner for mostly Francophone countries, because we speak the language and we can translate well, and backing up some of the training with Luni support. So very happy to be here, learn a lot throughout the journey, the last 2 years since 2021, working with Land Accelerator graduates like yourself. We've been in Nairobi, Kigali, we'll be in Malawi this year. But yeah, just very excited to be here to share some of our learnings and to really help our Francophone friends really understand what Luni is trying to say to all of you guys, entrepreneurs. I remember when I first met Luni, it's like, why are you not investing in Francophone Africa? And he said, I don't speak French. I like to know my entrepreneurs. I like to speak with them. I like to understand them. He's been in the backwards of Nairobi, places that even I wouldn't go in Kenya, but he hasn't been in Francophone Africa. So it is an opportunity for us to be able to do that work that he has done for Francophone countries. So very happy to be here.
Thanks, Rekia. Rebecca, where are your 11 investments?
Sure. So we have, we are sponsored by Acumen, but we're anchored by the Green Climate Fund, which means that we have to seek permission to invest in whatever country we can invest in. So we have permission to invest in Kenya, Uganda, Nigeria, and Ghana. And we just got permission to invest in both Tanzania as well as in Cote d'Ivoire. What's interesting though is while our kind of investments go into companies, activities in these, 4, now 6 countries, we have a lot of exposure to Francophone West Africa. Like for example, I would say Togo and CIV are 2 places that are kind of really, really exciting right now. But we also have exposure to Ethiopia, Rwanda, soon to be Malawi. So I think my takeaway is that while we only have permission to invest in a handful of countries, because of the expansion of our portfolio companies, we have quite a bit of exposure across East and West Africa.
Yeah, but it did start, just to point out, it did start in kind of the 4 biggest markets.
That's right.
And for all the entrepreneurs, when we run this program, we get flooded with Kenyan applicants. Like Nigeria is the biggest economy and the biggest population, but oh my God, do we get flooded with Kenyan applicants, and then Nigerian, and then Ugandan and Tanzanian and Rwanda, and it spreads from there. But that's kind of the hot spot of where small companies are applying to. I'm going to bring up a few slides. I didn't ask the guests to bring any, but I have some slides from a talk I did at Sunculp. This is Sunculp Global. Sunculp is the biggest conference in Africa for impact investing. And I did a talk on the missing middle. And the other investors will nod their heads. They know what the missing middle is. The missing middle is the fact that there are just way more small companies seeking capital than there is capital seeking small companies. Just a fact of the world. We can talk about why that's the fact of the world and how to fix it. But that's what Rekia and Rebecca's fund and my fund and company are doing, is filling in this missing middle. And part of understanding on why it exists is to actually understand why how venture capital works and what they're looking for, because they're not looking for you. And this is where we begin the realities of funding, is what I call it, and the frustration of raising capital for all the companies on here are considered SMEs, small and medium enterprises, as opposed to venture startups. So if you look at the headline number for I don't know, what was the number last year, Rebecca? Do you know, in Africa? Like 2020, the number was like $5 billion all-time high.
Easily.
Yeah, 5.2. Last year was 5.2 only.
Okay, so it went up. So if you go and Google venture capital in Africa, you'll find a number that's 5 billion, 5.2 billion. Nobody actually knows. It's not tracked well enough. It's a huge number, and none of that number is tracking anything that went to SMEs. So here's what the venture capitalists were looking for, or are looking for. They're looking for multi-billion-dollar opportunities. They're looking for business plans that grow really fast. Really fast being, 3 times growth year over year over year, once you get past the first big spurt of growth. So, first big spurt might get you to $500,000 a year in business, and then 3 times growth year over year over year after that. So 500,000, 1.5, 3, 9, and onward, past 10 and so forth. Of course, they're going to say they want a great team to execute. When you actually talk to them and ask them what they're looking for, their answer is team, team, team. They don't even talk about the first 2. They're just assumed in the model. And then they usually just stop talking, but there actually is 2 more assumptions that they have, 2 more things in their paradigm that they need. And by the way, I know this because I used to run software companies, and I used to take money from California venture capitalists. So I learned this from them themselves. So the next one is really odd for us as entrepreneurs, and I am also an entrepreneur here. The next one is that they have a fund. It's generally $200 million or bigger, 200 million, 500 million, $1 billion fund. A little smaller in Africa than in the States, but a large sum of money. And they have to spend it. So part of their business model is they're only going to make 20 investments in a fund. Rebecca's fund is, again, strange. It's an impact fund. So they're going to make 20 investments no matter the size of the fund. If you went to California and you asked 10 VCs how many investments you're going to make, you're going to get an answer of 15 to 20, whether they're running a $200 million fund or a $2 billion fund. It's always 20. So they have to spend about a 20th of their money on every investment. They have to find companies that need large sums of money. Otherwise, they can't invest in that company. They won't use enough money. And they get paid based on how much money they have, how much money they've been given. So they have no incentive of shrinking this. They have no incentive of finding a capital efficient company. They only have incentive of finding companies that burn a lot of capital. So they do. And then the last one is that they have to get out. Like, they have to get out of their investments in 10 years because they run 10-year funds. And it takes them a few years to deploy all this money. They don't deploy it all. That's the term of art. They don't spend all their money in the first year. They invest it over 5 years, which means for some investments, they have to get out in 5 years. And so they want to see an acquisition happen really quickly. So I think I have sorry. And then who are these companies that are acquiring, who are doing the acquisitions? And this is one they never talk about, because if they did, you would see the wizard behind the curtain. So who are the companies that are acquiring their startups, their funded startups? Turns out that they are the companies that got venture capital 1 or 2 generations ago. Now it's maybe 3 or 4 generations ago. But generally the companies that are buying companies funded by venture capitalists are companies that were themselves funded by venture capitalists. So Intel was in fact funded by venture capitalists in the 1960s, and Cisco in the 1990s, and Microsoft in the 1980s. And I can't see the last one because there's people. And Google was also they were funded in the late 1990s. And so it's actually this little virtuous cycle of venture capital buying venture capital, paying off venture capitalists. And we don't have that in Africa. There are no acquirers for companies that are like the ones on this call, which is why none of that $5 billion is flowing to the SMEs. And so we wind up with a story like this. We wind up with what's called the Valley of Death here in the States, or the missing middle of capital. But it's the fact that you got your company up and running somehow. Maybe you got a small grant, maybe you did it with your own money, maybe you had some friends and family, but you managed to get your company to a point where it was big enough that we picked you for the Land Accelerator. And you want to get to the other side of this gap, although I think the gap looks like that when we're talking about African SMEs. So it's a bigger jump. You are looking, most of you, for more capital to grow. And the question is, how do you cross the valley? How do you get over there? And in the States, you would be pitching an angel group. There would be at least one angel group in the city where you're based. Here in Seattle, there's 8. It's a very investing. It's a startup hub, so we have a lot more angel groups. You would pitch them, and they would hopefully fill in that gap. Or you could do some crowdfunding, or you could come to an accelerator that invests in the companies. We are going to give you a small grant if you do all the work here. So maybe that will get you over this gap. And then at some point in the venture world, you'd be big enough that there would be growth capital from the venture capital funds or the little seed funds or whatnot. And in Africa, this is a really big jump because there typically aren't angel groups in every city, or if there are, they're only doing a few investments per year. Crowdfunding hasn't really picked up yet, and the accelerators don't provide enough capital. So what we wind up with is this reality and this heartbreak that nearly all the SMEs don't get funding, that it's just too big a gap. And the gap is a different size depending on both your company and where it's based. But the poorer the country, generally, the smaller the amount of capital. And then we get to the next one, which is what's the size check that the funds can write? And so again, if you step back a few slides, the venture capital funds, if it's $1 billion fund and they're doing 20 investments, get that right in my head. That's well, anyway, that's multiple $1 million per investment. So I don't get the zeros wrong. They can't write a check of $5,000 or $50,000 or $100,000 because that's just not enough money out of their fund. When we get to the funds that are focused more on impact, then we tend to do more than 20 investments, and we can write smaller checks, but still usually not $5,000. That's still usually too small. So I'm going to put the slides away for a second here and jump back to our guests. So Rebecca, what's the check size and what's the outlook for your fund?
Yep. So we basically, we are a 10-year fund. So we can invest, well, we have to close our fund by 2030. So we have 7 years left. Our target number of portfolio companies is between 12 and 15. As I mentioned at the top of the call, we've already gotten to 12. And at the rate we're going, we will probably close 2 more investments between now and the end of 2023. So let's say we have one more investment. And that's really important for entrepreneurs to understand because, obviously when you're starting a business, this becomes like your baby. And so if an investor tells you, no, they can't invest, you might take it personally. Please don't take it personally. It has everything to do with the constraints that I, as an investor, have, and not necessarily your company, your business model, etc. So that's my first point. The second point is our minimum ticket size is 300,000, but our sweet spot, which is where we normally like to play, is between 1.5 and 3 million. And so when we're talking to entrepreneurs, there needs to be a really credible use of funds for that 1.5 to 3 million. And then the other point that's kind of embedded in this conversation is something called portfolio construction. We don't want a portfolio of just $300,000 early stage high risk businesses. We are looking at companies, maybe a third of our portfolio is $300,000 to $500,000 companies. Maybe another third is 1.5 to 3 million, and maybe there are 1 or 2 that take us to 4 million or 5 million. But portfolio construction is also layered into our decision-making process as investors that maybe you as an entrepreneur might not have a full picture of. So I appreciate Luni's comments to help to kind of educate you on what investors are thinking about in addition to your business plan or your company.
Great. Rekia, you want to comment on size or any of that I just covered?
Sure. appreciate that. And I think for us, just a caveat, we're still fundraising. We are going to get to first close this year. We're looking very good for it, thanks to the support of people like Luni and others. But what we're looking for is really that missing middle. And you know, Rebecca brings in a good point. We do want to have a portfolio of under $500,000 in terms of investment of companies in our portfolio. So we are not doing, in fact, when I see African first time, especially in the space of, you know, agroforestry, natural resources where we operate, when they're asking for millions of dollars in terms of funding that they need to begin with, we don't engage, right? We're looking to invest between $100,000 to $300,000, $500,000 most, and the $500,000 will be a combination of debt and equity. So on the equity side, we're only looking at about $250,000 because these companies are very small, and we don't want to own the company by giving you money that's 4 times what perhaps you earn. So size-wise, we are definitely looking at under $500,000 in terms of investments.
Yeah. Okay. So I'm sure there's over 100 people on this call. They all heard the words $1.5 million, and they got excited. So what's the reality of how much money can you raise for your company?
So look, I mean, it depends. And I think something to keep in mind about how much you want to raise. Yes, there's your expansion plans, but there's also that word that everyone loves to opine on, which is valuation. So you want to think about, you know, how your company could potentially be valued by investors. Sometimes you can put a number to it. Sometimes you can basically delay putting a value to your business. But rest assured, if let's say you want to raise $5 million, you have your plan, you want to expand, you priced out the equipment, you priced out hiring best-in-class talent, you priced out your working capital, it comes to $5 million. Excuse me, but if your company is more likely valued at 10 million, that means these investors are coming in and they're owning half of your business. And I don't know of an entrepreneur, I've never met an entrepreneur that's comfortable with an investor coming in and taking half of the business that they work so hard to build. So as you're thinking about how much money you want to raise, you do want to think about valuation, particularly if it's a straight equity investment. Look, if it's debt, that's a completely different conversation. Sorry, but from an equity standpoint, you will need to think about valuation. There are tons of different terms for you to Google when we're done. You know, there's equity, there's convertible notes, there's safe notes. I don't know the curriculum, maybe you guys have been exposed to that, but all this is publicly available information. So please take a moment if you are embarking upon a fundraise to understand the different types of ways that investors can invest in your business and decide not only how much you want to raise, but the right instrument for your business, given where it is in terms of revenue, size, et cetera, et cetera.
Yeah, Rekia knows what answer I'm looking for. You want to give him the
valuation?
No, not the valuation. The Rebecca was there in SoundCall too. So let's just say your company earned the equivalent of $50,000 last year, right? It converted from your local currency to dollars, right? You don't have to earn in dollars. And you're out looking for money. How much money can you raise?
Yeah, 1 times your revenue. That's the answer.
Yeah.
But yeah, and also wanted to add the topic of valuation. What we tend to find with the companies that we work with, valuation is numbers, is revenue, right? The impact is great, but for example, in Luni's example, your company made $50,000 last year in revenue, but your impact is so amazing that you think you deserve $1 million in investment. It's not going to happen, right? Investors rely on the numbers. So valuation is how much revenue are you making? Again, we deal with that, but my impact, that's amazing work. And we're here to support that. And we can put a number on what that impact is. There are ways to do that. But in terms of how we're looking for, and the reality of how investors look at, you know, if they're going to invest, is that what is the revenue? What is the profitability of this company? How viable it is and how scalable it is. Just wanted to add that there.
Yeah. All right. So do note for the entrepreneurs, there's two general ways that funding, or let's call it three general ways that funding happens for SMEs in Africa. One is grants. Do go and search grants, apply to competitions. Like it's not free money. It comes with strings, but you don't have to pay it back. It's lovely when it shows up. Second, and more popular than what we're talking about here, is debt. There are more debt funds than equity funds in Africa. But the challenge in the debt side of the funding, and Reiki didn't stress it as much as I wanted to hear. The reality on the debt side is that they will not give you more than you earned last year. That is the maximum amount that they would ever consider providing you. So if you earned $50,000 last year, and it's up from the previous year, if it's down from the year before that, you won't get anything. That's just another piece of reality. If it's 50,000 and it's up from 30 or 40 or equal to the previous year, and you go to a debt fund and you ask for money, don't ask for more than $50,000. And if you did $25,000 last year, don't ask for more than 20,000. If you did 10,000 last year, don't ask for more than 10. That sounds pretty simple, except I have not found a single debt fund that will do an investment for a company that has earned less than $500,000. We've had some on this panel in panels past that have claimed they'll do it for smaller companies, but I've never actually seen it. And I've been investing in Africa now for, 7 years, 8 years. And I have not once seen a loan to a company that didn't earn $1 million a year. Which is just a harsh piece of reality. So then we get to the third and less common path for investing, which is equity. So we have 3 equity investors on the call here. Although Africa Eats will do debt, TerraFund, which Rekia and Amanda and I all work on, and Sam and Fabiana, it does debt. But it's a really rare fund. It got created to try and fill in this gap as well. On the equity side, do you have a rule like that, Rebecca, on scaling versus last year's revenues, or how do you figure out the valuation of a company?
Of course, the magic word is that it depends. So what we do is, I'll say that the most systematic thing that we do is that we look at comparable companies. So basically we'll look at companies in the region that are early stage. And because we physically sit here in Nairobi, and half of our job is to get to know entrepreneurs, maybe even more than half of our job is to get to know entrepreneurs. So we're talking all the time, and we have access to quite a bit of confidential information. So we know kind of previous rounds and what similar companies' business models are, what their revenues were, and if they recently had a fundraise, we know what that multiple was. And so we use that data to get an understanding of kind of what's happening in the region, be it like East Africa or West Africa, and what valuations were and so on. And then we actually use a resource called PitchBook. And PitchBook is a database that collects information on previous transactions. So we try to blend what's happening specific in the region. For example, maybe, let's say tech is hot and their revenue multiples are 7, right? We'll also look at India to see what their revenue multiples are for ag tech. Maybe it's 9. And so we will from there, try to understand and make a blend. Maybe we will offer someone, 8 times revenue if they're a really great ag tech company. So it totally depends. In most cases, we are not able to use EBITDA multiples because some of our companies are not EBITDA positive at the time we invest. But I would say revenue multiples are what we use most of the time. Every once in a while, a company will grab our attention, and it's just a concept on the page. And we are able to usually just say, okay, here's an amount of money, and we will kick the can on the valuation, until the next qualified financing round and somebody else prices it. We have a number in mind, but sometimes it's entirely inappropriate to try to put a dollar value on a company if it's too early stage, and we're okay with that. We don't have to put a price on it. What we're really looking for is, are your fundamentals strong as a company? Is the management team, as Luni mentioned, really strong? And are you kind of a part of a growing and expanding market that we fully understand? Those are some of the things that we think about when we're looking at some of the early stage investments, and that's how we kind of think about valuation.
Nice. I was at a conference in London last year. It's called AFSIC. I don't know why. AFSIC. Second biggest conference for investing in Africa that I know of. And I don't know why it's in London, but that's where it is. And I mentioned the valuation methodology we use at Africa Eats, which is almost always just a multiple on revenues. We keep it simple. You're batting around some really big multiples.
For ag
tech. Yeah, the key is the word tech.
That's right.
Tech has higher multiples than planting trees or food by a lot. And I mentioned our numbers, and there were some private equity investors in the room. So there's a lot of jargon in this conversation. There's another way that investment happens in companies. It's called private equity, capital P, capital E. And it's about buying the whole company as opposed to investing in the existing team. I do not practice private equity. Everybody here practices venture capital, which confusingly falls into the domain of private equity, little p, little e. And private equity, capital P, capital E is also in the realm of private equity, little p, little e. All confusing. And the private equity people, the people who like to buy whole companies, they just looked at me like I was crazy. We would never pay more than 2 times revenue, which is really low. It sounds really low to the venture capital ears. And part of why they said that is because they're a business too. Like, you have to remember that investors are running a business. Like, we don't invest we're not investing our money. We're investing other people's money. It's a business. We're paid to invest other people's money. Same thing with the private equity people. They're paid to invest other people's money, to buy companies, do something to them, and then sell them again. Again, they have that same paradigm of they have to get rid of the companies that they buy. And so they have to sell them for more than 2 times equity. So they have to buy them low and sell them high. And so when I told them, would you sell a company for 4 times equity? They said, oh, absolutely, that's a good price. But they won't buy a company for 4 times equity because then they won't make a profit. So at Africa Eats, except when there's some very strange thing like we just got a free factory, which we did get a free factory for one of our companies, or they got a free factory for themselves. We just take the last 12 months of revenues and we multiply by a number. And which number we use depends on how well the company's doing. If it's growing, if it's doubling every year, they get the biggest number we put down. And if it's shrunk, they get a much smaller number. And if it's growing 50%, they get a number in between. And then we'll make an adjustment for free factory. We made an adjustment for, we just sold all the cashew nuts, but we just harvested all the cashew nuts, but we haven't sold them yet. So the revenues are about to go up, but we can't prove it. Amanda, you want to mention the poll?
Yeah, guys, I put into the chat box right now a poll, so everybody can definitely check the poll right now. I think I can actually, if I take 1 second, I can find out where to share it. Hold on, sorry, let me just find it on this share thing so that people can also have the chance to take a look at it on the screen. Show all windows, I think I need to do.
I see it's the most recent one on the chat.
Yeah, it's right there on the chat. Looks good. And here it is, just in case people want to just see it live. Yeah. So again, I'm showing it here so that if you want to, you can also take your cell phone if you're joining us from a computer and scan that code. So far, we have how many people answering?
That's not even 20. Come on, everybody jump in the poll so we can see the sizes.
Let me go back to the first question, which is easy. So we've got 34 people responding so far. So I think that we can probably just do this. So we do this just so we can get a feel for who's in the call today. Share that with ourselves. It's interesting, basically for everybody to know, who's raised funds and who hasn't. And of course, people who've raised funds, we expect you to raise your hand, ask some questions as well, and maybe share some experiences if you hear something here that matches up or that doesn't match up with you. So yeah, go ahead to that poll. Again, check the chat box or check this QR code. So I'll go to the next slide now. So we're not taking too much time. So please get on there and be a part of this. Again, we're up to 50 people. So thank you so much. Yeah, Luni?
Go. Let's see the answers, and then we're in the.
Okay, let's see the rest of the slides. Yep. Next one, I was asking folks to see what kind of funding that they have gotten so far. And I think we can see the responses here. I wonder if anybody on the, Luni, if you want to say something.
Yeah, I'm not surprised
slides.
at all.
Mm-hmm.
So starting with grants is normal because I think we had the revenue number. Let's see the revenue size.
Okay, yep, coming up.
Yeah, so these are mostly tiny little companies. Oh, you made even small buckets at the bottom. So mostly small companies with grants. Hopefully it's not Tony Alumalu, so that you all have the ability to go get $5,000 more. If you don't have it, somebody find his link and put it up on the chat window. So the Tony Alumalu Foundation gives away $5,000 string free, just gives away money to large numbers of companies every year. It's nice to get it. I haven't heard anything beyond the part about the grant being useful. So only one company over $1 million, only 3 over 100,000. Is there any other questions?
Yep, we've got one more, which is this one, just to see if people had additional questions. Sometimes when asked here, people get it together and we can kind of stare at the questions really fast. So again, if you haven't gotten to this slide yet, get to this slide and put your questions in. We've got 24 answers. Maybe we can go through some of them and see if there's anything interesting at this point, and then we can transition back to the discussion.
Yeah, why don't you, Amanda, why don't you not take away the share screen and then shoot us some questions.
Okay, perfect.
And for all of you, Rekia put the link to Tony Alumalu in the chat window.
Let's see, I've got a question here. Well, let me go through a few of them. Is it possible to raise equity with exit options? So looking to learn a little bit more about equity there.
Rarely, yes, but rarely. Fledge used to, well, when I was running Fledge here in Seattle, I haven't run one since the pandemic, since Africa Eats. We would invest in a form of equity where you buy back the shares using a percent of revenue. So it happens. There's other funds that do that, but it's not.
We structured investments like that as well. We call them, broadly speaking, self-liquidating instruments. So that and that can be revenue share, EBIT share, you name it. But that's certainly an option, especially when there's no specter or it's unclear how an exit might happen. We can build that in.
Typically, hold on. Typically in Africa, the way that's done is they just do debt. So debt is self-liquidating as well. You hand money to investors, hand money to a company hands back more. All done. No equity changes hands. Okay, go ahead, Amanda.
Oh yeah, perfect. So another question I had was, I'm from the United States with a business in Madagascar. The US investors are telling me it's too risky. The Madagascar investors are demanding too much. I've not tried other African sources. Do you have any tips, or what is your experience with this? Is it tracking with what you guys know?
Rekia, that's right up your alley.
Is it?
Yeah, we have a francophone country and everyone thinks it's too risky.
Yeah, exactly. I was going to say it's not just that. Again, the advice is to find the right investor. I think the right investor are there. I want to share maybe a tidbit of story, kind of like what the reality of funding is and what ultimately it is about, right? So there's a company, I think this week or last week in France, three French men. They have no website. They have no product, right? No product, nothing they've created yet, no staff, right? And they did fundraising and they raised $113 million in 4 weeks. In 4 weeks, it's all over the news. Everybody's talking about it in the ecosystem. Not to depress you guys, but there is money out there, right? So that happens. The reason why they raise funding though, is because of who they are. There are three young men with deep experience in AI, and their idea, their concept note is about this AI platform. Whether it's going to be successful or not, we don't know, but who they are as founders, convince investors. And that's really what I want to stress on a lot about raising funding and the realities of funding. I think ultimately you get funding, whether you're in Madagascar or in the US, based on who you are as a founder, your background, and how you're able to demonstrate to investors that their money is going to be put to good use. I'll stop there, but there's a lot more to kind of dig into, because even the question with the equity, how do we get exit? We get a lot of those questions from Africans worried about having an equity partners in their business. How do we get rid of it? Not understanding the potential of having a partnership with someone who can not only give you money, but help you build your dream, right? So all of that we need to explore and really kind of let go if we want to be in the world of getting money from outside, especially from, if you want somebody else's money, American money, right? You're asking for people to come and give you money and help you build your dream, and that can happen. They need to trust you. They need to believe in you. And you can get funding because, again, there's enough money out there. But yeah, I'll stop there. And
yeah, I mean, I'll add a little bit. So we just invested in a company that sources cacao and vanilla from Madagascar. They process it into chocolate bars in Madagascar, and they sell it into North America to various retail outlets. The company is called Beyond Good, and they make really good chocolate and vanilla products. I think to our friend who is in the US and is having trouble raising money for his or her business in Madagascar, I think it's really important to deconstruct risk a little bit and just understanding what is risky, what is the perception of risk tied to. So with this particular company, the risk of sourcing in Madagascar is offset by a couple of things. They have a local partner there that facilitates manufacturing, but then the product is de-risked because they're selling into North American markets. So there's a commercial de-risking that happens there. The company is actually incorporated in the US, right? So there are these investor protections there that give investors comfort that if they make an equity investment, they'll be able to, get an exit at some point in time. So without knowing much about your business model, I think you mentioned that, some people think it's too risky, the price is too high in other places. Just, it's two sides of the same coin, basically. They're both saying it's risky by the price that or the hassle factor that you're alluding to in your comment. And of course, US investors are quite direct. They will tell you that it's indeed risky, but really try to unpack the risk and what risk they're referring to, and really think about whether or not it makes sense commercially to structure your business in a way that facilitates capital flows, maybe that, invites a different set of investors around the table. So I would say go a little bit deeper and double click on the feedback that it's too risky to understand if there's an opportunity to de-risk or restructure things in a way that is both suitable for your business as well as suitable for income and capital.
What percentage of your 11 investments are run by Americans and Europeans?
So maybe it's easier for, let's see, I guess I could, give me a second. I think it's usually about 50-50, by the way, and that's unique to agriculture. Acumen has funds that are like energy focused, and it's all European and American founders. What we found inside of Acumen, that certain sectors lend themselves better to local founders. Agriculture is one of them. You have to really understand the nuances of the market from the time a seed is planted to working with distributors and buyers and certain varieties that grow better here than in other places. Like there's a very, very healthy amount of local context that you have to have in order to do agriculture well. So our portfolio usually reflects that imperative to have that like local understanding. But if you give me a few minutes, I can go and do the math for you.
I don't need the exact number. The point of 50-50 is the point I wanted to get across.
Sure. And I would say that's unusual in some sectors, to be fair.
Yeah. So what's really unusual is my portfolio at Africa Eats is 100% African. That's highly uncommon for capital that's raised outside of Africa.
We have.
Thank you. Amanda, were there any other questions from the Menti?
Yes, we do. And actually, I did just click the wrong thing. I found that if I clicked on a question, it erases all the other ones. So let me see what there. Let me scroll down for another good one. This person, if I could ask my friends to help me mute people while I'm doing these questions. Thank you, Fabiana, Samuel. Okay, great. Is there a land accelerator app? I don't even know where the person is. He needs to be muted.
Yeah, go ahead.
Okay. Is there a land accelerator app that helps us figure out what type of funding we are looking for? A sort of assessment app regarding debt, equity, grants, etc.
Yeah, I just had this conversation with a land accelerator graduate who's in Africa Eats. I think must have been last week because it's Tuesday. He just doubled the size of his company. It's $124,000 of revenue last year, which is great because that's double from the year before. I'm sitting on mute. You can kick her out as well if you can't stay off the phone.
We'll kick her out next time. So if that happens again, whoever keeps muting her, just kick her out. Thank you.
Okay. And we had met this company. They were in the Land Accelerator second cohort. That would have been 2019. And when they were there, it was a company like a lot of the companies here. It was maybe $25,000 a year company, maybe 20. And I hadn't checked in with him in a while. I was talking to him, and he's got some new products. The products are selling. Company's doing really well. He'll probably double again this year. And he's like, well, how do I go get more money? Like, nice, simple question. It's a totally reasonable question to ask. Where can I go to get some more growth capital so I can continue this growth or speed it up? And the answer I gave him was the answer I gave everyone in this call a few minutes ago, which is you can't. Like, we'll write you another check if you send us the quarterly financials like you're supposed to, and do everything we're asking you to do. But I can't introduce you to anyone because you're just not big enough. And it's not the answer he wants to hear, but it's just the realistic answer there is. So I know of 0 equity investors in Africa that would invest in a company at $124,000 a year of revenues. And I have a small list of lenders that say they will, who I've seen no proof, who will very likely do due diligence on his company for 18 months while he's growing it. And maybe at the end of 18 months might write a check, and maybe not. Don't know. Well, probably not, because again, history's shown with the companies I worked closely with that a lot of funds will kick the tires, as we say, for months and months and months, or over a year, and still not write a check at the end of that process. And we've also seen, just to make this more depressing, usually I put the disclaimer in the front that this is a depressing topic. I have blogged about the fact that we had one funder who had a really good name in the industry, kick the tires on one of my companies for 10 months, and then send in terms that were just ridiculous. Like, send in terms for a loan that were just utterly, I'll use the word stupid. Stupid for them because, nobody should have taken those terms. We pushed back and said, no, if you change these 3 things, we'll accept your money, but we're not accepting it with these terms. And they spent another month talking about them and then reneged their deal. Said, okay, well, if you don't want these terms, we're not going to invest at all. They did not negotiate with us. And then they tried to charge us for their services. And we did not pay that bill. So realistically, you have to find a way to get a company that's $500,000 a year in business on grants, on small bits of money, on accelerator programs, on winnings from business plan competitions, and then keeping your eye open for things like often there are programs listed on VC for Africa, vc4a.com, and there's money attached to them. And I don't know if that's actually an accelerator or just a competition or just TA with money. I don't keep track of all of those, but I have seen some money flow from that.
I will add to that. If you do pursue grant capital, that's fine. But you do want to be able to convert that grant capital into revenues, meaning that you really need to use the money to prove your concept out, prove your market, develop your product, and show that there is indeed traction, so that when it's time to get to a funder like me, I'm going to look at where you've gotten your funding from. And I want to know that you have developed a product that at scale, or even a medium or a bit more scale, there's really, you have really something there, and not just kind of, de facto NGO because you've used grant capital to fund your OPEX, but you've used it strategically to actually come up with something that the market will receive well. So that's what I would add to Luni's comment.
Rowan had a really good question in the chat window about underfunding, but really it's a question about tranches. So there's underfunding as in you really need $100,000 and you got 30. And all you're going to get is 30. And there's the other issue, which is the investor agreed to, let's call it 120, because it's in the number, it's in the chat. And they gave you 30 to start with, and then there's something you have to do to get the rest. That's called tranches. Investors do tranches to try and minimize risk. So when they don't believe, either don't completely believe the team, or don't completely believe the financial model, or don't completely believe in the opportunity, they'll de-risk their work by saying, okay, we'll give you this amount now, and here are the milestones to unlock the next money. And you are agreeing that those milestones will happen, and you're agreeing the tranches are reasonable. And if you've agreed, if the first tranche is way too small, you shouldn't have signed the document. Like, I know it feels like, well, if I don't sign it, I'm not going to get anything. But ultimately, if they got to the point where they're offering you tranches, then they like you. And you should honestly sit down and figure out what the real numbers are to make it all work out. And it sounded, my guess is you were a little too timid at pushing back on saying, I absolutely need this amount. In my work, it often comes down to the financial models. I'm a very financially oriented investor. I will sit down with an entrepreneur and build it with them if I have to. But I need to see, given this money, here's what will happen. And if we can come to a understanding and belief that that is true, given this amount, this is likely to happen, not going to, but likely to, then we'll write the check of that size. And if that model says you need, $120,000, but if there's a way in that model, if the model's for a whole year and we can see that you really only need, let's just say half of that for the first 6 months, then it should be totally reasonable to give you half of it now and half of it later, understanding that the model probably is just a model and won't come true. But if something happens and you need a little sooner, in my work, I usually have the relationships with the investees that we can just have that conversation in 4 or 5 months saying, oh, the model was wrong. We need a little bit more money now instead of later, and we'll just adjust it. So that happens sometimes too. But if it comes down to, I can't do this business without $120,000 and all you can raise is 30, well, then what you need to do is sit back and figure out how to make a bigger business on 30. Right? Every dollar should help grow the business by $1, ultimately.
Yeah. Can I just add something really quickly as well to the question of access to funding? So what Luni said is, this is a depressing call. It is right. It is a reality that there are a lot of funders out there, but there are a lot of upcoming funds, I will say. Some are already operating, and I'm talking specifically for West Africa because that's where I operate and I know. But if you're making $300,000, like our friend in the chat room is asking, and you want to raise funding, and you believe with some funding you can get the company to $1 million, there are a few of us who will be very, very interested in talking to you, right? And also depending on where you are. So in West Africa, some of the companies I'm going to mention are in West Africa, including the Barca Fund. We're focused in that region. But that's where we want to invest. The companies that are about at that stage. There's WIC Capital, WIC Capital in Senegal in the region. There is Comoe, COMOE in Cote d'Ivoire. You know, there are a few funds that do these deal size of missing middle. You know, apart from the one that have been mentioned, that you can approach and start talking to, but knowing that it's very difficult. The reality is very difficult because a lot of us have a limited amount of money that we can deploy. And you know, for us, you know, we're looking to do 20 to 25 deals in the next 3 to 4 years. We already have 5 companies in our pipeline that we love and we want to invest in. So there isn't a lot of other companies we can take on. But I have to say, in terms of the momentum and what I've seen, you know, just being in the ecosystem, there are a few funds that are coming up, targeting missing middle, targeting companies like yours in this ecosystem that can potentially fund you. Again, especially if you're making $300,000 a year in revenue already.
Okay, all right. There's a really good question here for Rebecca from Joseph here. What if my company can demonstrate a potential for $1 million of funding, but it just hasn't done that yet? Yeah. How does the future potential projection tie into valuation and odds of funding?
Yeah. So for ARAF, and this is not true for everybody else, because I've seen other investors, you know, will basically make some assumptions about your future cash flows, and then we'll, you know, do some sort of valuation magic and come up with a number. That's not necessarily how we function. We need traction. We need proof that you're actually able to deliver on it. And so we tend not to rely on future revenues. So there's this notion called like trailing 12 months. So we look at the last 12 months and we'll give you a number based upon last 12-month revenues. If there's a potential, and I'm sure everyone on the call has the potential to generate $1 million in revenue, what I would expect is that we would not price the round. We would not give your company a valuation. We might use what I called earlier a safe note or potentially a convertible note that will delay the pricing of the company for when we have demonstrated revenue that we can use to apply a revenue multiple and then come up with a more reasonable valuation.
Okay, nice. And we are at the top of the hour. I did ask Rebecca to come for just an hour. Yeah, I don't know how long you want to stay. We have another hour here. We'll be talking for another hour.
Okay.
So you can tell me, you got to go, and you can go.
Yeah, I should probably go. Someone else is waiting for me. But I'm happy to answer maybe one more question or 2 more questions while you have it. I'll put my contact details in the chat box. So you can, I'm totally fine with you contacting me and asking more questions if you like.
Right,
I'm happy to get to know.
We'll do the hard one here, which was asked twice, which basically comes down to many of the companies on this call are putting seedlings in the ground. Those seedlings are going to take 3-4 years until they have any value. How do you deal with that as an investor?
Yeah, it's not easy. I mean, we've looked at tree planting companies before. We also look at companies who are planting orchards and, you know, will be processing the fruit into pulp or some sort of value added product. So we're happy to look at those types of companies, but for us, and this is speaking for ARAF, I cannot speak for all investors. It would be difficult for us to value that business. We would first of all, we would look for the entrepreneur. We look very closely at the entrepreneur and his or her track record for doing this type of work. Let's say, for example, they used to work at Del Monte. Del Monte had, they were the Kenya managing director for Del Monte's operations here, and they decided to spin out and do their own thing. That gets our attention because it's significantly de-risked because of the work experience of the entrepreneur. If there's someone with a good idea, and there are lots of good ideas, there's been numerous tree planting, projects that have come our way that have gone on to be incredibly successful. But for us, there wasn't enough demonstrated traction for us to get comfortable with. Primary ag, which is where you put something in the ground and you grow it. Primary ag is the most risky part of the entire agricultural value chain. So many things can happen. There can be bad inputs. Your yields for a myriad of reasons may not be what you want. Maybe your integrated pest management system didn't work. Maybe you had too much rain, too little rain. Your soil quality, which is often the case, is too acidic. There can be so many issues on the primary production side of things. And there are numerous investors that will tell you that they've lost money on primary ag and they won't do it anymore. We don't subscribe to that. We will still do it, but we need some more proof. And what we would tell you, especially if you're in a really interesting crop, let's say, for example, well, everyone's in avocados nowadays, but say if you're in like a really high value crop, or if you're in non-GMO or organic, where there's going to be a very high premium attached to your product when you do get it out of the ground, we'll say keep in touch. And we mean that. We will ping you every 3 to 4 months to see how things are going. We're very happy to connect you to people in our network that might provide technical assistance or grants or what have you, or if there's a consultant that we know about. We really try to be as helpful as we can be before we can actually invest. But it is just part of our work. Not every investor is like that. But without some more proof of concept, it would be hard for us to both price as well as invest in companies that are still putting things in the ground and growing them as the very first stage of their business.
Okay, tough answers. One last question before we let you go. Is there going to be an ARAF 2?
Yes, there will be. We're actually going to go out to the market in Q1 of next year. So super exciting. Fingers crossed. Remember, I think one thing to remember that entrepreneurs is that investors have to fundraise as well. And it usually takes us about 2 years to fundraise. So just know that we know the struggle well. We have a different set of issues that we're dealing with in terms of fundraising, but yes, we hope to raise somewhere around 120, 150 million, which is all the reason why I'm very happy to keep in touch. We are looking at Francophone West Africa as well as Anglophone West Africa. So all the best to all of you. Very happy to be a resource. Thanks, Luni, for inviting me. Rekia, so nice to meet you. Very, very nice to meet you. And best of luck to everybody.
Yeah, thanks for coming. All right, Rekia, let's actually go back to the question on tree planting business. How do we solve that problem at TerraFund?
Well, the good news
how do we try and solve that problem at TerraFund?
Yeah, the good news is that there is a mechanism or a platform that our friends at WRI with Luni and others have been able to create, really, to fund and take the risk on tree planting organization, right? TerraFund only was last year. The pilot project was in 2022. Typically, the funding that received by WRI and other international NGO always go for grant giving organizations, for only go through NGOs. And so Luni and the team were able to convince, let's get some money to you guys, right, who are making profits and building companies in this sector that also need funding, but typically will not be eligible because you don't need grants. You're looking for loans. So in TerraFund last year, there was $3 million that went to 20 companies, right, ranging between $50,000 to $400,000. Small, low interest loan. No one is doing it in the ecosystem, right? 8%. I saw a question about what is the interest rate. Should I pay on a loan? It depends. It depends where you are. If you're in Niger, you won't get a loan for less than 15% from the bank. If you're in Kenya and other places might be lower. So how much should you pay in interest for a loan? It depends where it's coming from and where you are. But TerraFund is offering 8% loan to organizations like you guys who are tree planting, but there is a business model that Rebecca just alluded to, where there is an element of access to market to farmers by buying the production and transforming it, and then selling that production, whether it's macadamia nuts or moringa or what the crop is, or avocados, and transforming it into oil. We've funded companies like that. And they're also typical tree planting nurseries, building type of company that have been funded to TerraFund. And I think you'll hear more about TerraFund, but TerraFund has a limited amount of money. And that we come back to the same problem, to what Luni described in the beginning, right? There isn't enough money in the ecosystem to fund all of you. There just isn't. It's a competition, even with TerraFund, but I think you already have a leg in, if you will, because you are part of the Land Accelerator and you already know some of the folks that make the decisions at TerraFund.
Except that we're also limited to specific geographies in
Geography.
2023, which we were not
years.
limited to in 2022. So most of the companies on this call are not in the right location for capital in 2023. If you had seen the TerraFund application from a few months ago, you might have been frustrated by that. Just note, we're frustrated too. We didn't want that, but the funders wanted that. Yeah, so basically, when an investor is looking at your company, one of the takeaways you should have from today's conversation is that, yes, we care about where it could go, but mostly we're caring about where it's been. Mostly we're caring about seeing what you've done in the last year and how that compared to years past. And I'm going to show you some examples. I'm going to flip back to some slides. So this was last year's Land Accelerator funnel. We had a few more companies apply last year than this year. This year was 1,350 and last year was 1,421. Either way, it's a lot of companies. So just in terms of competition, in terms of who you're competing with, when it comes to fundraising, you're competing with everybody else who's raising money. So there's we just saw the ARAF fund, and they only do ag and ag tech, and they're only going to do 13, 14, 15 total ever in their fund. And there's about 100 other funds that are like them, that are doing similar investments, and they're going to each do 15, 20, 25, 30 companies a piece. You add that all together and it's a few hundred. If you added together every single fund in Africa that would fund in the agriculture space and how many companies they would ever fund in total, the number is going to be less than 1,400 by a lot. The actual number of all those funds is going to be a few hundred, maybe 1,000 at most, but it's probably going to be a few hundred in any given year. It's actually going to be a small few hundred. And this was just a snapshot of 1 year of applicants just for the Land Accelerator. So another takeaway is there's a lot of competition out there for funding. There are way more entrepreneurs who want funding than there are investors who are funding, who are writing checks. That's just one of the realities. So how do you get picked? How do you get to be one of these companies that gets told about a story? Well, I have a couple examples here. They're all from Africa Eats. But all these companies applied to a business accelerator and got in. And so why did AgroSupply get accepted into Fledge in 2020? Well, one thing is that was their growth spurt from 2017 being year one. And I don't show what 2018 is here, but 2 years later, they're a $98,000 a year company. That's not all why they got in. One reason was that they got to be a $100,000 a year company on about $20,000 of grants. I don't think there was any angel money in this one. But mostly they got accepted because they had a business model that I hadn't seen anywhere else. So they sell seeds. This is a seed seller. I'm sure that all of you could name 10 companies that sell seeds, like, and where they are. This is the only seed company that I've ever seen that sells with a layaway model instead of a cash or a pay later model. I found that to be interesting, and they were doing well, and the rest of their story was good. And when they got interviewed, this is the right guy. He used to work for One Acre Fund. He built a great team. Like, it just fit everything. But first and foremost, it was an interesting model. So at Fledge, the first check we write is $20,000. Everybody at the accelerator gets $20,000. And then he got the first check ever from Africa Eats for $55,000. The Fledge investment was equity. The Africa Eats investment was a loan. We lent him $55,000. He had 20 from Fledge. So that's $75,000. And with that, he doubled the size of the company. So more than doubled, right? Slightly more than double. So with $75,000, he grew by $119,000. So for each dollar we gave him of investment, he earned more than $1 of revenue. That is not commonplace. It doesn't happen that often. And because of that, we were excited about this company and gave him more money in 2021. Literally, because of that growth spurt and that capital efficiency. And so what did he do in the next year? Well, he asked us for more money, of course. And we provided, again, some more loans. Some of the loans we converted to equity because the loans started coming. The asks for loans started coming one after the other as the company grew up, because it grew fivefold that year to $1 million. And so this does happen sometimes. But you are competing in terms of capital. You're competing with other companies that are on this track or have already completed this track of getting to $1 million quickly. And as I said earlier, of the hundreds of other funders in Africa, most of them don't even start looking at companies until they're over $1 million in funding. So now that this one is bigger than that, there are other institutions that are kicking the tires and talking to them. And one even provided what's called a term sheet, which is an intent to invest, but not a promise to invest. And sometimes that process lasts for months. And in this case, I think the term sheet came in January, and here we are in June, and they haven't actually closed the investment yet. And maybe they'll never close the investment. Don't know. But what did this company do last year? Yeah, we basically gave them nothing in 2022. Relatively speaking, we might have lent them $50,000, but at this scale of company, $50,000 is tiny. And they doubled again. It's actually 2.2 million. These slides are old. So they doubled again to 2.2 million, which makes them even more attractive to investors. Let's talk about this underfunding question. Sometimes there's something you need. Sometimes there's a piece of equipment you need. And you need it in order to grow. So I found this company same year, into 2019, fourth largest dairy company in Tanzania. And I know that's not restorative ag, but Africa Eats is food, not restorative ag. And when I was interviewing this entrepreneur and asked him, how are you going to get bigger than $132,000? He's like, I need a new pasteurizer. Like I have one, but it's at capacity. I just can't make any more milk. I need another pasteurizer. And I still remember this interview really clearly because his answers were all too common. I said, okay, how much is the pasteurizer? And he says, it's more than I can afford. And I said, okay, how much is the pasteurizer in dollars? And he said, I'm going to have to import it from China. And I said, yes, I understand that. I've been investing in Africa for a long time. I understand they don't build pasteurizers in Africa. How much is it going to cost? And he says, it's going to be really expensive. And I said, okay, but give me a number because I'm an investor and I can't write expensive on the check. I need to write a number on the check. And he said $17,000. And which, and I had no idea at the time, right? Because this is the first dairy I invested in. I didn't know if his number was going to be 17,000 or 170,000 or $1 million. I just had no idea. And when he said 17,000, to me, given I write checks of 20 as Fledge, this was again back in Fledge 20, I said, well, I'm going to write you a check for $20,000 if I invite you in. And so what can you do with a $17,000 pasteurizer? How much bigger can the company be? And he said, oh, well, we could be 10 times bigger. I said, well, then we should invite you in because if that's all you need, and by the way, this is the pasteurizer he purchased, like he did get invited in, right? Shouldn't be a surprise in this story. And lo and behold, he did grow 9 times that year. So he grew from 132,000 to 1.2 million in a single year. And I warned him when it was 600,000, when it was looking like he was going to be a $600,000 a year business, like 4 times bigger. I warned him that if you grow 5 times in 1 year, you will be stressed beyond all belief. Yeah, you will not understand how hard it is to grow 5 times. Yeah, he has a little bit of regret of growing this fast because it is incredibly stressful. It's incredibly hard. Almost everybody who works for your company after you've had a growth spurt like this is new. Almost everybody in your company is just hired into your company because of course they are. You were a tiny company the year before and now you're gigantic. Not gigantic, but big. But it was actually going to be a $600,000 or $700,000 a year company until December when he had a glut of milk, made some yogurt, and it was a hit product. So he almost not half, but like a third of this income came in December. And then he had absolutely no investment the following year. Nothing new, no money from anyone. And it grew to $1.9 million the next year. And then what happened? I don't have what happened on the next slide because I usually don't tell the story. What happened was, for all you in Tanzania, you remember 2022, big drought, huge drought, no milk. The milk literally dried up. We were worrying about the cows surviving. We were not worried about the milk production. We were literally worried about having milk cows the next year. So it dropped by a lot. I think he did about 600,000 the next year. And then this year we expect it to pop back up. These things happen. I think I have 2 more stories here. Rwandan came and applied to Fledge in 2016. I invited him to Fledge in 2016, but back then we used to fly people to Seattle and the US wouldn't give him a visa. He had never been outside Rwanda. US by default doesn't let people come in. 2017, I invited him to Seattle. The US wouldn't give him a visa. But lucky for him, I had a Fledge program in Peru. So Hervé, the Rwandan, flew from Rwanda to somewhere in Europe, to somewhere in the US, to Peru. It was a very long day. He went to the program in Peru. We gave him $15,000 in Peru. He actually had 2 companies at the time by the time he showed up. But we've merged them back together. It's a meat processing company. So again, nothing with restorative ag here. He was literally grinding up animals to make sausages. Still does. And you know, his whole equipment at the time was 1 hand crank sausage machine. And so I had the same kind of conversation as the dairy years before, which was, well, what do you need to grow? Like, do you just need some more hand crank machines, or, you know, is an electric machine useful? And does the electricity work in Kigali? So we had those conversations. And anyway, I do have that picture here. When he showed up in Peru, he had a second company that was working with farmers to it's a distributed system for them raising animals, and a way for the farmers to make money raising animals that they couldn't afford to otherwise raise. And what was interesting about that business was that he promised it would make no money for years. It had no revenues in 2017, and he promised it would have no revenues in 2018, 2019, or 2020. That it was all about raising the livestock and creating a commercial scale amount of livestock. We merged those together back in 2022, and it did make money eventually. But I actually invested in both companies. I gave him $15,000 and said, split it however you want amongst the 2 companies. Those 2 companies combined did $780,000 in 2021. Again, the slides are old. They did 1.4 million last year. Total amount of capital ever invested in this company was, oh, sorry, and I didn't mention that on this one. Total amount of capital ever invested in Regathi Dairy is $65,000. total ever from every source. $65,000 got to this scale company. So Livestock Bank was a little bit bigger and PMP was a little bit bigger. By the time we got to this moment in time in 21, it was maybe $100,000, all from Fledge and Africa Eats. So $100,000 built a company that was $780,000 in scale. We invested, I think, about another 100 since then, but they're at 1.4 million last year. Capital efficient companies are the ones that investors get excited about. And I do have that. So it did hit 1.4 million.
Luni, I have just a quick question around your stories. How can companies on this call realize if they're likely to grow like that with a relatively modest investment? How did these companies realize that they might be, or how did you see that they might be able to be capital efficient?
You have to work. Yeah, that's a great question. What you should be thinking of when you're dreaming of raising more capital, whether it's that $5,000 Tony Illuminou grant or our $5,000 grant or a TerraFund loan, or being invited into a company like Africa Eats, you have to be really focused on, given that money, what can I spend it on that will generate a lot of revenues? Given $5,000 of grant capital, what is the best use of that capital to go and generate $20,000 of revenue, or $15,000 of revenue, or at least $10,000 of revenue, as opposed to, I'm going to get the $5,000 in and I'm going to fill in these gaps that I know I have and hope that my company grows. You got to be focused on the revenue growth. Revenue growth attracts investors' eyes. And ultimately, in these stories, these entrepreneurs are so focused on revenue growth, they'll hit a little financing hurdle, but it won't be a giant hurdle. It won't be that I need them. They're not dreaming that, back when this company was this size, he wasn't dreaming of, if I only had $1 million, I would have $1 million a year company. He was just focused on getting the next pig in the hand of the next farmer and selling the next sausage. And from that, kept building a company that every month got bigger. And we've seen this in I think the last story I have here is we'll flip to it, is East Africa Fruits, which is, I didn't mention this when Rebecca here. This is the one that she and I overlap on. ARAF is the latest investor in this company. And what this company does, so again, this company, I met them at the end of year one. The entrepreneur, it's a fruit and vegetable aggregator. And in the first year, they were able to sell $100,000 worth of fruits and vegetables. Don't know how. On almost no money, on his own little amount of savings. He made it to $100,000 of sales, basically break even. He might have lost $1,000, but close enough to break even. And then Fledge gave him $17,000 as equity, and some friends of mine lent him $50,000 in as a loan. And that's all the money he had to get to $1 million a year. So how did he do it? He just kept selling fruits and vegetables. He set a goal that, in this case, he's not the one growing the food. So again, it's not primary agriculture, it's aggregation. He had a broad enough series of products that it wasn't seasonal. And so he just set a goal that every month he would sell more than the previous month, 10% more. And if you can come close to growing 10% per month every month, then you double the size of your company every year. And so he did that for year after year after year. His actual progression was 100,000, 300,000, 600,000, 800,000, 1.1 million. I think that's how we got from, I think it was 300,000 of 14, 15, 16, 17. I think I'm off by it. I think there's one more year in there. It might have been 100, 300, 6, 8, 1, 1.1. Right. It wasn't always doubling, but it always went up every year. And then this company did just shy of $11 million last year on the same premise of every month I need to be 10% bigger. And How do you get from 1 million to 10 million? Yeah, then you get a large sum of money to come in. So ARAF invested $4 million earlier this year. Another fund called Goodwell invested $1.5 million, $2 million. The total round was about $3 million a year and a half ago. So again, once you get up to the scale of $1 million a year, it is possible to raise $1 million. And then it's possible to raise $2 or $3 million and so forth as it gets bigger. So those are kind of the examples of what's out there. And 2 points is, one, it's possible. It is possible to have a small company and 5 years later have a big company and do it on a small amount of money. And secondly, and more importantly to this conversation, there are companies that are doing this and you are competing against them, which is hard. It's a hard reality to have to swallow, that most of the companies on this call are $10,000 a year. How on earth are you going to get to 30 or 50 or 100 so that you can start getting on this treadmill and get much bigger? And so when you're getting this grant, you should be focused on, how does this grant triple the size of your company? And I don't have the answer for you. You'll have to figure that one out yourself. Every company is different. Okay, I'm back in the... Okay, so Joseph said, my presentation suggests, yes, so most of the funders out there in the world are looking for larger companies. I'm not most funders. This is why Rekia wants to be Luni. I have found I have jumped into the missing middle of capital because it exists, not because it's less risky, not because it's easier. It's not, and none of those are true. It is harder. It's harder to raise capital. It's harder for me to raise capital in that space. It's harder for these companies. I'm only telling you the success stories. There's of course some failure stories in here. But I'm showing you that it is possible that it is possible that some companies that are smaller do get investments and can grow to be larger companies. The use of these slides was at Suncorp Global. I presented them in November of 21 or October 21, presenting to investors, showing them that there is opportunity to make money investing in these companies, trying to inspire more companies, more funds to jump in and fill in the missing middle. Because again, there's thousands of companies at this space that need money, and a handful of funds that will invest in it. Okay, I will stop. Reiki, what do you want to add to that?
And I think this is all very excited. Again, I think the question really about how do you get investors when I'm making $20,000 or $30,000 to take that leap of faith and believe that I can reach the 1 million. One depends on you, the founder, and two, how diligent you are. And part of it is luck, right? I think Hervé was very lucky to have fund Luni, because there aren't a lot of Luni out there, especially back 6 years ago when he was looking for funding. East Africa Fruit, same thing, where he had this incredible growth story, where we talk about him all the time. In fact, like last week on the 42nd floor of the skyscraper in New York City, there was somebody presenting about poor Africans, and I got up and I talk about East Africa Fruit, and everybody got excited, right? Because those stories are exciting for people to know, for investors to know, for the ecosystem to know. And so how do you do it? You keep at it. You as a founder, right? You know the company. You do as much research, to find investors who will be interested in funding you. But you keep at it and you keep asking a lot of investors. One person says no, that's okay. I think Rebecca shared that. Don't take it personal, right? They have their constraint, or perhaps it's just not the right fit, and that's okay. You just got to keep asking more investors, and to get that $20,000, that $50,000 equity or debt investment that's going to get you to the next level, and then you raise more. You don't have to raise all of it right away, right? If the investor said their cap is $1 million, you don't ask for $1 million. Ask for what you need now, show what you can do with it, and then keep keep asking. The great story I like about East African Fruit when you talk to him is every stage he had investments to be able to get to that level, right? He didn't go from $100,000 to 10 million all on its own based on, you know, reinvesting the profit. That's not how he grew. He grew with investment at each stage, with the latest investment being $4 million from our friend Rebecca. So each stage you get more investment. This is why investing or getting investment is a long-term relationship, right? The people that supported you in the beginning are going to be with you in 10 years from now. That's one of the reasons it's good to be nice to them too, right? Like it's a long-term game. And as you continue to grow your business and then build your venture, you get to meet more investors, you get to get more money so you can continue to grow. So the key part is investment is not a one-off transaction, it's really multiple investment throughout. And get that first one so you can get more, because investors like to invest in other people who have already been invested in.
Yeah, Joseph asked, are funders not able to evaluate small companies with high potential?
Right.
And ultimately, it's not that they can't, it's that it takes a certain amount of effort to go and evaluate a company. Doesn't matter what size the company is. If the company did $10,000 last year or $1 million last year, actually takes a little bit more effort to do the $1 million, but not much more effort. So again, you have to think of investors as businesses. It's a very strange business because the product that they sell is money. They charge something for it. What they charge is either interest for lending or equity as equity investors. So they're charging something for their money. You know, as Rebecca said, funders have to go out and raise money too. It is not a fun process. Raising money for a company and raising money for a fund is a very similar process. It is just as frustrating. I have literally talked to 1,000 potential investors by now. And I have some, but not enough. You never have enough investors. And so the money that we raise as investors is precious to us. We're going to want to deploy it. We're going to have to deploy all of it because that's our job. That's our product. And most investors will take the easier path and invest it in the largest companies they can afford to invest in, because they're already large. They're already, we'll call de-risked. Odds of $1 million a year company failing are a lot smaller than the odds of a $10,000 a year company or a $100,000 a year company. So why would you take the extra risk? You can deploy more into the bigger companies. And if you're going to do the process of raising money for a fund, the logical and reasonable path is to go raise a bigger fund. So you might have missed this, but Rebecca said that the ARAF fund she has now is $50 or $60 million. I don't remember I remember it's 56 or 50. And the next fund, ARAF2, is going to be 100 or 150. Oh, look at that. It got bigger. Why did it get bigger? Well, one, they have proof. It's like a business. A, they have traction. They have proof that what they did works. B, because with that traction, they can go raise a bigger pool of money. And 3, because they actually get paid on how much money they raise. The business model of a fund is typically based on how much money they're managing. And so if they can go get a bigger fund, they'll get a bigger fund. But the downside will be that they'll probably still only make 15 or 20 investments from the bigger fund. And so instead of their sweet spot being $1.5 million to 3, their sweet spot will be 3 to 10. And they'll be even farther away from all the companies on this call. And I will be talking to them, as I do with every fund, saying, that's nice, but what you should do is carve out 1/20th of your fund and go invest in small companies with it, so that there are bigger companies for you to invest in later. And it's not very common when they listen to me on that, but some of them do. I don't take the easy path. I take the harder path of there's a large number of companies that need small amounts of money, and I'm going to do everything I can to get smaller amounts of money put out.
And I guess the last thing I want to say about the realities of funding perhaps is, and share, is that you know, a lot of the times when we talk to entrepreneurs, and recently we're in Abidjan where we did a session with 6 entrepreneurs, is that I think that founders or especially in the context of Africa, thinks that investors want to give money. And that's not really how it works. You know, it's money that we raise ourselves, right? And so when we meet when we meet a potential investee, we're literally looking for reason to say no. I know Luni is different, right? Like again, but we're looking just work with the premises that when you meet an investor, they're looking for reason to say no, right? And so when you're working from that, what you want to do as a founder is give them reason to say yes. And so whether it's, you know, the pitch deck or the presentation or the story or the numbers, right? Because there are different points that they're going to go for. There's so much risk in what we're doing, especially in the context of like raising money from people that we have to convince, typically in the US, that, you know, Africa is the new space, Africa is the new opportunity. And again, it's more than impact, right? We're not charity, right? Charity is grant, charity is different. So we have to get into the mindset. You need grants to be able to grow, but what we're doing, impact investment, is for-profit solution that we believe can be scaled with a little bit of investment to start it so that Rebecca can invest in them in the future. But somebody needs to do that work. And so even for us, when we meet someone, it's reason to say no. And I know it hurts. The people, the founders that we spend time with, were not happy to hear it. Their egos kind of went up, you know, like, really, I'm building something great here. It doesn't work that way. So if you start with that, then you start thinking about what can I do for my companies to make sure I prepare myself to get yeses. That there isn't a reason for the investor to say no. And really you have to think about it and, you know, sleep at night dreaming about it, right? Like have a plan in place, have a strategy in place, and that's how it's going to happen. Or it happened by chance. You can leave it to chance and let it happen, but that's 0.01% of times. But if you really want to get funding, you really got to start thinking about, how do I convince investors that I come across, or even partners, or, you know, people who might not be investing now, but who might know someone who invests, to say yes to all I'm doing, but not just the impact part. Again, leave the impact there, but the company, the business, the understanding of it, where you want to get at, the vision, the numbers, some basic stuff you have under your sleeve that you can pull every day and refine as you grow to get investors to say yes to me. Because I know they're probably looking for a reason to say no. And there are multiple of reasons to say no because there is enough people waiting to get funding. I think that's really the realities of funding, that investors are not in a hurry to write checks. It takes a long time, and that's the name of the game. But they do invest, they do deploy that capital, they want to invest, they want to support you and help you grow. And so how do you make sure that your company is the one that's selected?
Okay, so what are investors expecting to see from you? Not surprisingly, it is the homework that we're assigning in this program. Like, this is why the program exists here, to prep you to be investor ready. So first and foremost, somewhere the investor is going to see a blurb about your company. That could be an email that you sent them, or could be sitting on VC for Africa, or could be in a program of a program guide of this program or something else. They're going to see a very short description of what you do. Ideally, you've written that as opposed to somebody else. And when I say short, one paragraph that describes what you do and makes it look like something that they want to read another paragraph about, or open up the pitch deck. And again, you have to think of the fact that you're competing against every other company that is raising capital. So not just the other 100 companies in this program, but the other 100 companies over in the other programs, and every company listed in every other place where companies are listed. Weird. And so what you should do is spend some time trying to craft a really interesting opening paragraph. And it should not start with your name, and it should not start with the word social enterprise in the first sentence. It should be some opening of an interesting story. And I think we did a little bit of this on the very first week. Kalahari honey exists to try and save the elephants. I don't remember exactly how we did the opening paragraph, but the point of the honey company was to save elephants. That was interesting. that got the attention of investors. That's the first thing is the blurb. But then when you get past the blurb, well, the next thing that the investors are going to see is your pitch deck, most likely. Right? So you need a good pitch deck. Well, we went over what a pitch deck is supposed to have in it. It needs to look, I didn't go over all of my rules. It needs to look like you're already funded. That is the bar. So the pitch deck needs to look so great that the investor is curious on why you want money. This looks like a funded company. This was mentioned earlier today, but investors like to follow other investors. Most investors don't like to go first. Most investors want the comfort of either investing in a company that some other investor has already put money in, which is of course a catch-22, or something that just looks like it's been funded. So one reason why we keep touting East Africa fruits everywhere we go is A, they've grown 100-fold since I met them. They're succeeding. But B, they just look great. Like everything they do just looks polished. Go follow them on Twitter. You'll see what I mean on polished. And of course, they're a $10 million a year company now, but they've looked this way. Like that's the same logo we've been using since 2014. Like the fit and finish and polish of this company has always looked funded, even when funded was $17,000 of funding. So pitch deck, and that means iterating on your pitch deck. Go through my lesson, go make it, go show it to others, go make it better. Go find someone who has some design talent. If you're not an artist, if you're not a graphic designer, go find someone who's studying that and go get their help and make your pitch deck look better. Again, you're competing against tens of thousands of other pitch decks out there. Then what can you do above and beyond those two? Well, site visit video, which is why we taught you to make a site visit video. And so Amanda just put 99 designs. That's my logos all come from 99 designs. I've been playing around with the AI tools. They can do almost as good a job. Like you can go get a free logo now if you just fire up some AI image tool on your Bing and just ask it for a logo and ask it for 100 logos and play around with them and you'll get one that's decent. It'll save you $300. But in terms of like graphic designs of your pitch deck, I showed you a before and after of is either truck or PMP, and it was just drastically different feeling that you get as an investor between the normal everyday pitch decks we get that just don't look great and the ones that come from graphic designers. It just makes us feel like we're dealing with a company that knows what it's doing when we get a pitch deck that's done by a graphic designer. And that comfort is if we get the comfort of the pitch deck and then the comfort of the financial model or financial plans or historic financials that look good as well, then all of a sudden we're in the comfort zone as opposed to I'm trying to figure out whether or not trying to figure out what this company needs in terms of help as opposed to needs in terms of money. We talk about that a lot and when we're reviewing companies for TerraFund, is, okay, this company looked okay, but it looks like they need help with accounting. This company looked okay, but that pitch deck that they provided just didn't look great. Or this company looked okay, except they provided us with a URL that didn't go anywhere, that was either dead or said it was under construction. The little details like that do matter. Like, why would you share? If we asked you for a URL of your website, if you don't have one, don't give us a URL. Some of the applicants to the TerraFund put wri.org in as their URL. Like, and that might be a tiny little thing, but to me, it was like, you either misunderstood the question or you didn't have a website and felt like you needed to put something in there. But really the ones that upset me the most was when someone put in a URL in it and it went to an under construction site. It's nice. You have to have the third part we're going to have you build here is a website. It's the 21st century. You're expected to have a website. It's just all funded companies have websites. So it's something you need. All funded companies have a pitch deck. It's something you need. All funded companies have a financial model to show what might happen in the future. You're going to need one of those. We'll do that one in the second stage of this program. All companies need a reasonable description of what they do in a short amount of time, so that not just to get our attention, but once we've decided to invest in you, we're going to use that blurb ourselves to go raise more money. And sometimes I have to write it myself, but I much prefer when I can just grab it from the description. The application somehow allows people to put in no URL or put in a dot or a dash or something, but don't put in one that's dead. And it might have been this one too, expected a URL, but if you don't have one, you just put in NA or put in http:// NA. Whatever it takes to get the application in. But if you don't have one, don't act like you have one. That's a bad sign. That's a red flag. It's just like when we asked for pitch deck, a rare occasion, it did happen once in a while, but someone would put a URL in for the pitch deck and it would go to something else. It would go to the website if they had one. Well, that's not a pitch deck. Like, we asked for the pitch deck. We're expecting a pitch deck. We didn't expect a website for that. And occasionally on the accelerator applications, someone will answer every question with a URL, the same URL over and over and over again. They just think that they've answered these questions before somewhere, and we'll go track down the answer, but we won't. Again, you're competing against all the other companies out there that are raising money, and the ones that jump through all the hoops that will do what the investors want are the ones that are going to get funded, and the ones that don't are going to be the ones that get frustrated.
And remember, it's a long-term game, right? Like, getting the first investor, it's great and you've done everything right, but you want to continue to also do the right thing so you can get more investors, because it takes investment to build a $10 million company, right?
Yeah.
No one expects an aggregator that's just buying and selling fruits in Tanzania, right? Very low margin to get to 10 million without investment. We all understand that as investors. We all understand as part of the ecosystem. But it's the right team, the right person. It's doing all the right things that investor wants, and being a good person. I think that matters to be said in the that people want to work with, an investor want to work with, that made it possible for him to do what he's done in 8 years, right? 100 times in 8 years. That's Facebook type of growth, and happens in Africa. And we're just excited to be able to talk about it, because we think that helps us not only raise more money to be able to deploy in Africa, but encourage more people to take up this work, right? There are a lot of jobs when you graduate from the ecosystem. We know that we're from there. And so you're building ventures that are significant for you yourself, building wealth for yourself and your communities. And so if there's going to be investment to help you get to the next level, we want to be able to get it and be able to get it for you.
Okay.
But yeah, it's definitely a long-term game.
So let's finish off with what happens after. What happens if all this works out and you do in fact get an investment? Then what?
Then you're raising for the second one, the next one.
So the first thing to note is never tell an investor that this is the last money you'll ever need, because it's not true, not a true statement. You may feel like that's true today, but reality is once you start on the path of getting money from investors, you're probably going to stay on that path for the next 5 or 10 years until you're a $10 million business. And even then, you still might be raising more money. It still takes money to make money, even when you have a big multi-million-dollar company. So this is a path that leads to more of the same thing. Learning that I had this year watching East Africa Fruits, to keep talking about them, is now that they're past $10 million a year, the problem they're having is that the investors can't write big enough checks. That, they got 4 million from ARAF, but what they needed was 6. So they had to go get more money from other investors, and then they needed some operational capital that needs to be from a loan from yet another investor, but there wasn't anyone that could do that. So they had to go get that from 2 or 3. So the troubles of raising money never go away, or don't go away until you're much, much bigger. Second thing to keep in mind is once you're on this path, and this is an optional path, but we should say that this is not a path you have to take. You could go take the $5,000 grant and never go raise another dime and just build a nice business out of that. Totally possible. It will take longer. It will be just as much of a struggle, if not more, but it's doable. There are companies that don't follow this path. But if you do jump in the investor path, then keep in mind that investors are business partners. We'll say that 3 more times. Investors are business partners. So the investor is now, whether it's debt or equity, doesn't matter. They are now your partner in your business, and you need to treat them like a partner in your business. And so the best practice is a monthly update. You're going to send them at least an email every month with the status of the business. You're going to treat them literally like your co-founder and tell them what's going on. They're not going to work for you. They're not going to show up every day for work, but you're going to treat them as if they were, just on vacation, and you're going to update them every month. And then the second best practice is formal quarterly updates. So I send out mine are a little bit long, but I send out about a 12-page document to all my investors every quarter for Africa Eats. Details, financials, what we learned, what went well, what didn't go well. And key piece is also sharing what didn't go well. So one of the reasons why investors invest is to make money. And especially in the realm of angel investors and seed funds and little funds, we invest because we like startups, we like little companies, we like to see this growth, and we know as investors that they won't all succeed. I'm not sharing my failure stories today. I have another talk on that, but there are plenty of failures in my investments. I know there will be failures, and if I get updates and there's only good news, then I know that the entrepreneur is hiding something. That's not what you do with partners. You share the good news and the bad news. And you do that on a regular basis. And you do that when you're out courting investors as well. It's really useful to have these formal quarterly reports around, right? Even if you're just doing it for fundraising, because you can use it as a tool to show the investors what happened in the last few quarters, and show them you know how to communicate, and show them that you are open to communicating, and get them comfortable with what's going on in your business. And again, I'm just doing this in Word. This isn't a highly designed document. This is literally just a Word doc with some pictures in it, and some text and some financials. And I share it with everyone who's already invested. I share it with about 100 potential investors. And when I find a new investor, I will often send them after the pitch, I'll send them the previous quarter's update. Okay. And we are just about out of time. You want to close it down, Amanda?
Oh, yeah, certainly we can. Wanted to say thank you. I'm definitely keeping a check on this chat box. We put the attendance sheet in just one more time, so if anybody's missed that, it's definitely there. This has been a really great session. I think there's obviously a lot to look at. That's why we're recording these. I will sneeze, sorry. Excuse me. That's why we're recording these. We have the slides from Luni today that will also go up, because as you go on through your business, you might want to reference this at any point, and you're going to have access to this recording anytime. And so I think that the thanks is right there. And I also always love to get a chance to a shout out for Samuel. So Samuel, would you like to share something from your end as well, and what you've been seeing, in Africa, perhaps maybe as you've come back from Sankalp in Ghana last week?
Yeah, thanks, Amanda, and certainly thanks so much, Luni and Rekia, for sharing this important topic, which we have never got an answer here in Africa. We don't get to see where this money is, where are these investors. But certainly having this conversation today gives everybody an idea of what it looks like to actually access investment, and especially from this part of the world. So thank you so much. Yeah, so last week I was actually in SANCAP and interacting with quite a number of investors. Certainly they were there to be able to scout for good projects. But the conversation I could hear from them is that we are not able to identify good projects on the ground, despite actually seeing real companies there with real products, well branded. But still there is that conversation. We are not able to get good pipeline. And on the flip side, the company is saying we are not able to get investors. So there is a gap there. And Luni, as you said, that's why we have such a program, to be able to tell these restoration entrepreneurs, hey, look, we have a pitch deck that needs to be there when you're communicating to these investors. We need a website and everything that we have been able to share here. So yeah, so for the entrepreneurs, mine is to encourage you. Yes, we may not get there. It's not your problem. It's something that is happening continentally, even with other sectors. But the best thing we can actually do is to be able to start. Make sure that you have the right documentations in place. And for us at the Land Exeter, we certainly be able to ensure that you have all those requirements. And then we should be able to identify 1 or 2 investors that we can link you with. And at the end of this program, even as we get to phase 2, we'll be able to profile a few investors and be able to share some of your deck. So we have what is called an air table that really profiles you. And that is what we actually share with investors. And should an investor be interested with you, certainly they will be able to reach out. Otherwise, thank you so much. Yeah, back to you, Amanda.
Well, thank you all so much. I think then that we will invite you to come on for Thursday and see you next Tuesday. We are going to just every week, we're reminding you about preparing your upcoming website, preparing your slide deck and also your site visit video, getting those URLs ready. And Fabiana's also put in the chat box the Airtable, which is the database with everybody's contact information that you can browse anytime. So I think that that's it. We can say goodbye. If anybody wants to turn on their cameras, their screens, and just say bye. Thank you to everybody. We really appreciate you joining. Thank you to Luni and Rekia, as always, for being a part of the movement to get more funds to Africa.
Thank you.
Bye.
Thanks, everybody.
Bye.
Bye.
Bye, bye, bye.
Au revoir. Bye bye.
Thank you.
Au revoir. Bye
Bye
bye.
bye. Bye.
Bye.
Bye.
Bye.
Thank you. Bye. See you next time.
Bye. Bye. Bye.
Bye, guys. Thank you.
Bye. Bye.
Bye.
Thank you.